Okay, so you want to own a skyscraper. You picture it, your name on the deed of a glass tower, 1,000 feet of Manhattan or Chicago stacked into the sky, elevators full of people who pay you rent, a lobby with 40-foot ceilings and a security desk that knows your face. Somewhere on the 60th floor, a law firm signs a 15-year lease and the checks just arrive, month after month, while the building sits there doing nothing but existing. That's the picture. That's the trophy. Sounds simple. It is not simple, because a skyscraper is not a building you rent out. A skyscraper is a shopping mall stood on its end, and just like a mall, you are not really selling floors. You are selling one anchor tenant's signature. Here's what the listing doesn't show you. The tenant paying you the least per square foot is the one holding up the entire value of the building, and that value can drop by $200 million in a single afternoon without one person moving out. Let's start with what it costs to get in the door. A modern Class A office tower runs somewhere between $500 and $1,000 per square foot to build, and in dense cities, the top of that range is the floor, not the ceiling. One World Trade Center came in around $3.9 billion. One Vanderbilt next to Grand Central cost roughly $3.3 billion. Hudson Yards as a whole development ran past $25 billion, and here is the first cruel thing about height. The taller you build, the less of the building you can actually sell. Every extra floor needs more elevators, and elevators need shafts, and shafts run all the way down. Add mechanical floors for the air handlers, add stairwells, add the structural core that keeps the thing standing in a 50-mile-an-hour wind, and in a super tall tower, somewhere between 20 and 30% of your floor plate is machinery, steel and concrete, and moving parts you can never lease. You pay for 100% of the tower. You collect on 70. Height is not a bonus. Height is a tax you pay for the view. Past a certain point, every floor you add costs more than the floor below it and earns you a little less of itself. Which is why the world's most famous super talls are usually trophies, marketing, and tax structures long before they are good investments. So how does the money come in? Layer by layer. Layer 1 is base rent. In Midtown Manhattan, Class A office space asks $80 to $100 per square foot per year. In a genuine trophy tower, new construction, big views, brand new systems, asking rents cross $200. On paper, 300,000 rentable square feet at $100 is $30 million a year. Beautiful, except that number is a fiction, and every landlord in the business knows it, because the tenant who signs at $100 is not paying $100. To land them, you give 12 to 18 months of free rent on a 15-year deal. You hand over a tenant improvement allowance, $100 to $150 per square foot, cash, to build out their offices. You pay their broker, run the math across the term, and that $100 face rent becomes a net effective rent closer to $65 or $70. The headline number exists so the building next door doesn't find out what you actually took. Which brings us to layer 2 and to the reversal at the heart of this entire business. Somewhere in your tower is the anchor, the bank, the law firm, the tech company that takes 6 or 8 or 12 floors on a 20-year lease. And the anchor negotiates like it. Bigger free rent period, bigger build out money, softer annual escalations, the right to put its logo on the roof. Per square foot in real net effective terms, the anchor is very often paying meaningfully less than the 2-floor hedge fund on 11. Why would any owner accept that? Because you are not selling that anchor space. You are buying their credit rating. A 20-year lease from an investment-grade tenant is not rent. It is a bond. It is a stream of contracted income that a lender will underwrite at a lower interest rate and a larger loan, and that a buyer will pay a premium for. One Vanderbilt didn't just get a tenant when TD Bank anchored it. It got the proof. The anchor's signature is what turns a pile of glass into a financeable, sellable asset. The little tenants pay your bills. The anchor sets your price. And then there are the layers most people never think about. The ones that live above and below the office floors. The retail podium, the first 2 or 3 levels, on the street which lease at multiples of what office space does. Rooftop antennas and telecom equipment which pay real money for a view of the sky. Parking, signage rights, sold to a company that wants its name lit up over a skyline. And if your building is famous enough, the observation deck, the Empire State Building's observatory, pulled in roughly $128 million in 2019 from an attraction occupying essentially 2 floors at margins the office business can only dream about. Now, the leaks. Operating a Class A tower costs somewhere around $20 to $25 per square foot per year before taxes. Cleaning crews, engineers, cleaners, security, lobby staff, elevator maintenance, HVAC, water. You wash the windows with a suspended rig on a schedule. Forever. Every 20 to 25 years, the elevators need modernization. Hundreds of thousands of dollars per cab in a tower with 40 cabs. Eventually, the facade needs recladding, and that is a 9-figure conversation. Then property tax, which in New York City can run $20 per square foot or more on its own. Routinely the single largest line item in the building, larger than every employee combined. And now, energy law. New York's local law 97 fines buildings $268 for every metric ton of carbon over the limit. And towers built in the 1970s and 80s are discovering that their heating plant is now a recurring 7-figure penalty. And here's the trap inside the trap. Almost none of that goes away when the tenants do. An empty floor still gets heated. An empty tower still gets its elevators inspected, its lobby staffed, its insurance renewed, its tax bill delivered on time. Your revenue is variable. Your costs are close to fixed. That gap is the reason skyscrapers don't decline gently. They fall off a cliff. Add it up, and a third to nearly half of every rent dollar never reaches you. What's left is net operating income, NOI. Remember that word, because now we get to the part that actually decides whether you're rich. Your building is not worth what it cost. It is not worth what the bricks weigh. It is worth exactly your NOI divided by a number called the capitalization rate. The yield buyers demand for owning it. That's the whole valuation. NOI divided by the cap rate. Say your tower nets $50 million a year. At a 4.5% cap rate, it's worth about $111 billion. At a 5.5% cap rate, it's worth about $909 million. Read that again. Same building, same tenants, same $50 million in rent hitting the account. $200 million of value gone because interest rates moved and buyers repriced risk. You did nothing. You lost nothing you can touch, and you may now owe more than the building is worth because the loan you took at $1.1 billion did not move at all. That decimal is the real landlord, and the thing that pushes it around most violently is the anchor. Blackstone bought 1740 Broadway, a solid midtown office tower, in 2014 for $605 million. It was a good building with a good anchor. L Brands, the retail giant, filling the majority of the tower on a long lease. Financeable, sellable, exactly the asset everybody wanted. Then L Brands left. That's it. That's the whole domino. The anchor's floors went dark. The contracted income stream that made the building a bond turned back into empty carpet, and every buyer looking at it now had to underwrite the cost of re-leasing hundreds of thousands of square feet in a soft office market. Free rent, build-outs, brokers, years of vacancy, NOI collapsed, and the cap rate blew out in the same motion. In 2022, the building traded for around $175 million, roughly 70% of the value erased. The mortgage was $308 million. The lenders did not get made whole. Nothing fell down. Nobody stole anything. One tenant declined to renew. So what does the modern skyscraper owner do? Increasingly, the answer is stop pretending it has to be an office at all. The best towers are becoming vertical mixed-use machines. Office in the middle, retail at the street, hotel or residential up top, and observation deck at the crown. Because a building with 4 unrelated income streams doesn't die when one industry catches a cold, and the towers that can't compete are being converted. 25 Water Street in Lower Manhattan, a 1960s office block nobody wanted, is being turned into roughly 1,300 apartments. The largest office to residential conversion in American history. The land under a dead skyscraper is still worth something. The question is only whether the thing standing on it is the right shape, because in the end, that's what you actually own. You think you're buying a building. You're not. You're buying a bundle of promises from other people to keep paying you, and a market's opinion about how much that bundle is worth today. The steel doesn't generate value. The signature on the lease does. A skyscraper looks like the most permanent thing a person can own. Thousands of tons of concrete sunk into bedrock, built to stand for a century. But it doesn't stand on bedrock. It stands on a decimal point, and somebody else moves it.